So, good afternoon, ladies and gentlemen. So my name is Faraj, and today I will be talking to you about Seychelles as the premium fintech hub destination. Before we begin, I know we're also running a little bit short on time, so I'll try to go through it as quickly as possible. Before we begin, I'd just like to ask a question for the audience. How many of you have attended a fintech conference this year? If yes, please raise your hand. 1, 2. Okay, so not a lot. Okay, that's good, because today we'll be going through a brief overview of fintech, for those who are not too familiar with the topic. So the simplest way to define fintech is a form of technology that incorporates financial and technological aspects in the delivery of financial services. And in today's world, we know the word fintech is commonly associated with terms such as the blockchains and cryptocurrencies, peer-to-peer lending, banking or mobile payment systems, but fintech also extends beyond just alternative financing mechanisms today. AI and robo-advisor services is also a growing trend. And most of these terms are quite modern, such as blockchain. Even though the concept existed previously, it gained popularity back in 2018 with the introduction of Bitcoin, of course, and new cryptocurrencies have been emerging since then. And even though fintech is commonly associated with new technology that we have today, the fintech is actually now in its third era. And the first stage of fintech started way back in 1866. So I'm going to take you through a little history course here. The first fintech era started in 19th century, and it's commonly associated with the laying of the transatlantic telegraphic cable, which at the time provided the fundamental infrastructure for the period of strong financial globalization that was happening at the time. And in 1918, the US Federal Reserve Banks developed the FedWire fund service, which was the first electronic fund transfer system. Following that, in 1950, the Diners Club credit card was created, and in 1967, the world's first ATM bank was unveiled by Barclays. So you're thinking, okay, hang on, it's not very relevant, is it? Because these are old, archaic technologies, such as telegraph and the Morse code. But it's important to pay attention to this, because the truth is, even though these technologies are very old, they still perform the same function that fintech performs today. It incorporates financial and technological aspects available at the time to help deliver financial services to its customers. And most importantly, this was the time when the first infrastructure started developing, which would help build the future developments in fintech. Which brings us to the second stage. These developments brought us to Fintech 2, which was all about shifting from the old analog technologies to the new digital. And at the time, that was spearheaded by the traditional financial institutions such as banks. Electronic payment systems started advancing rapidly. FedWire, the previously mentioned system, became an electronic system. And NASDAQ came along, becoming the world's first digital stock exchange. SWIFT was also established in this time, 1973, and to this day remains the most commonly used communication protocol, facilitating large volumes of cross-border payments. And as technology evolved and global financial markets became more and more interconnected, new risks and problems which were previously unseen and just didn't exist, they started to appear. So shortly after SWIFT was established, Herstatt Bank collapsed in 1974, which highlighted the risks of increasing international financial interlinkage. It was this crisis that triggered the first major regulatory focus on fintech, with the establishment of the Basel Committee in 1975, leading to a series of international soft law agreements. Following that, there was the stock market crash, which was called the Black Monday, and it was yet another step where security regulators worldwide had to create mechanisms to support cooperation. Moving forward, advances through the mid-90s, such as online banking, internet, and e-commerce, highlighted these risks in complex computerized risk management systems. But these risks did little to slow down the ongoing growth. And by the time of the beginning of the first century, banks' internal processes, interactions with outside and retail customers had become fully digitized in the Western world. So as we can see, this fintech area is much closer to what we see today. It's modern, it's digital. But here's where the crucial difference lies. The previous fintech was delivered mostly through traditional financial institutions. These were regulated entities, these were banks. And even though there were new concepts such as e-banking, it was still based on a very traditional banking model and the new risks did not emerge from the products, but it was more about the digitalization of the services itself. For example, even though now customers have e-banking access, the ability to make an instant withdrawal from your bank account increased the stress on the banks and the access that online banking created new credit risks. But still, the regulation was applicable mostly to big financial institutions, and that's what changed the most with the third era of fintech, which we are in today. So the current era of fintech, which is fintech 3, changed the landscape of finance and how it is delivered. It was a number of factors at the time which came together around 2007-2008 to provide the impetus for fintech 3 in developed countries. And the most important thing which helped shape the industry today is the shaken reputation of banks at the time, especially after the global crisis in US and UK, where customers simply started preferring and trusting technology companies more than traditional banks. And with that mindset, popular payment systems started to gain traction, and alternative payment methods such as cryptocurrencies started to emerge. The same phenomenon appeared in China, especially, where peer-to-peer lending platforms operate outside a clear regulatory framework. But this did not deter millions of lenders and borrowers because of the cheaper cost and the increased convenience compared to a traditional bank. Building on top of that, smartphones have also become the primary means by which people access the internet and use financial services. And that's where the critical difference in fintech 3 lies. It's about who is providing the financial services. It's the startups and the technology firms which are now starting to supplant banks in providing niche services to the public, business, and the banks themselves. So now let's take a look at the five major areas that comprise the fintech industry today. So first of all, we have obviously the finance and investment. As I mentioned earlier, the fintech extends beyond just alternative financing mechanisms like P2P lending and the use of technology in financial transactions such as algorithm training. Fintech is also increasingly involved in areas such as AI and robo-advisory services. We then have the internal financial operations and risk management. So these 2 points have been the core drivers of IT spending by financial institutions as they're building better compliance systems. For example, for Goldman Sachs, engineers comprise about 1/3 of the 33,000 staff. We also have the payments and infrastructure. Payments have been an area of great regulatory attention since the 1970s, resulting in the development of both domestic and cross-border electronic payment systems. And similarly, infrastructure is central for security trading and settlement, which is why, as you'll see later on, IT and telecommunication companies today are seeking opportunities to disintermediate these traditional institutions. We also have data security and monetization. So the digitalization of the financial industry means that it is particularly vulnerable to cybercrime and espionage. So we have seen several cases of this in the past, and this will remain to be a major concern for governments, policymakers, regulators, industry participants, and customers. And lastly, we have the consumer interface. The consumer interface offers the greatest scope for competition with the traditional financial sector, such as banks, because existing tech companies can leverage their pre-existing customer base to roll out new financial products. And interestingly, it is the developing countries where this phenomenon is most evident, as we will see in the case of Asia and Africa. So in Asia and Africa, the landscape is very different to the West. The previously mentioned reputational factors that encourage the perception that only banks can offer such services are, put simply, irrelevant, because there are over 1.2 billion unbanked individuals in these regions. And the general perception is that banking can be provided in any institution. It doesn't have to be limited to any bank. It's the banking that is necessary, not the bank itself. As a result, in China, the technology has already blurred customer perceptions of who can deliver a financial service. I'm sure you've all heard of Alipay. They process over 1 million transactions each day by means which resemble a traditional bank without being a bank. And Alipay has provided over 400,000 small and medium enterprises loans ranging from $3,000 to $5,000. This is almost $2 billion in sum. Similarly, in China, there has been still an increase in new internet banking customers, over 19% in new personal bank accounts and 24% in online payments. In Africa, on the other hand, the landscape is different from Asia, because only 20% of African households have access to formal or any sort of semi-formal financial services compared to that 60% of Asia. And as I mentioned, telecommunication companies earlier, this is where mobile money has really taken off, which is basically a payment and services, saving services through e-money recorded on a mobile phone. These mobile payments have significantly spurred economic development by providing customers, which mean to save funds, they want to remit money safely to their families and relatives, they want to pay bills, and they can even receive government payments securely. And the most well-known success story in Africa is the M-Pesa, which launched in 2007. Just to demonstrate how massive it is, just in under 5 years, the payments made through M-Pesa surpassed 43% of Kenya's GDP. And going back to Alipay as well, it is these fintech giants that really highlight one of the most important aspects of fintech today and what makes it so different to the previous models. Traditionally, a growth model in the fintech world followed these steps. So it is a gradual growth, going from too small to care to too large to ignore and too big to fail, which is usually the case with banks. And this is the model that organizations traditionally followed. And so this has changed. And to give you an example, 3 of the largest players in this, in the money market funds are Vanguard, Fidelity, and Schwab. And these were established in 75, 46, and 63 respectively. In 2014, Alibaba started to offer the same services, however, that was fully online and available to their pre-existing customers. And within 9 months, Alibaba became the world's 4th largest MMF, showing how a non-traditional financial institution can move quickly from being too small to care to being simply too big to fail. And as this exponential growth represents a direct challenge to gradual regulation because it skips the too large to ignore phase where regulators could have started to request compliance. So the difference between FinTech 2 and FinTech 3 is that players create distinct expectations and needs for industry supervision. For startups, the high cost of regulation is often incompatible with their typically lean business model, and they prefer more flexible compliance obligations, and sometimes they just don't have experience dealing with regulators. So the regulatory approach today must adapt to cater for these trends while ensuring that risks are mitigated, which brings us to the regulatory sandbox approach. So how does the regulatory sandbox approach work? As we saw, the industry today is facing innovation from a lot of players who have to comply with still, to this day, mainstream regulation. So introducing sandbox regulation allows these 2 factors to come together in a very flexible and experimentation-oriented regulatory regime. Having such approach allows regulators to have a very balancing act between a soft-touch regulation and risk management. Even more so, as mentioned by our chairman, Mr. Patel, there's a clear need to implement sandbox regulation in Seychelles for a variety of reasons. And one of the biggest reasons is that as the 3rd biggest international financial service in the world, we have a very large amount of IBCs providing fintech in a potentially unregulated environment, which provides a very clear reputational risk to Seychelles as a reputable jurisdiction. Surrounding that, we have the need to implement new legislative and regulatory and supervisory framework to cater for such companies, which in turn will allow for increased market development and innovation, granting us insights into new technologies, and most importantly, we can counteract the stagnation of traditional IBC product and services by allowing new players enter the market under the sandbox regulation in Seychelles. We're proud to say that our framework has been developed by some of the top legal firms, as mentioned by Mr. Chairman. So the inception, so the legal framework inception was done by Hogan and Lovells, followed by the legal framework refinement with Appleby, and then independent assessment of framework by PwC. And again, just to mention, our staff has also been trained by PwC. They have also developed the operating model. So you can rest assured that the capacity is with the FSA to cater for any needs that you might have for these applications. And the regulations have been finally issued in 2019. So now let's take a look at the regulations in Seychelles for the regulatory sandbox. So how does it work? The regulatory sandbox in Seychelles is exemption-based. What that means is that the applicants are provided exemptions from requirements of Securities Act 2007, where most of these applications would usually fall. So that means you will not have any licensing requirements, you will not have any disclosure requirements, or you will not have reporting requirements traditionally required by the legislation. But the FSA still has the ability to impose conditions and restrictions depending on the type of application or product that you wish to provide. And regulations themselves will also impose certain conditions and restrictions. And of course, the types of businesses that we're targeting is the digital asset marketplaces, including crypto exchanges, digital custodians, and security token offerings. So let's take a look at the application process and the flow of work. First off, we have what we call the authorization stage. It is the application stage of the applicant where we will review your application, and we will work together with the applicant to develop certain testing parameters defining customer safeguard measures, and we will understand and learn how to mitigate risks for this test product. Following that, we have what we call the supervision stage. So during this stage, we'll be overseeing the applicant as they test their product and service in the sandbox regime, and we will be developing relevant regulatory frameworks in anticipation of the successful exit of the applicant, which leads us to the exit stage, whereby FSA will be managing the sandbox exit process at the end of the testing period to make sure that the applicant can fall under one of the regulatory frameworks, and the success or failure of the exit stage will affect the eventual outcome. So throughout the testing process of the product, there will be reporting, framework management, and ongoing regulation development and support. So on the reporting side, there will be requirements for internal reporting and external reporting. For framework management, there will be managing changes to existing regulations, and at the same time, there will be monitoring done, the monitoring development in other countries to make sure that our framework is up to date. There will be refinement of the existing legislation and as well developing new legislation. Okay. And we have a governance structure on the regulatory sandbox, which is comprised of 3 layers. So the first layer is the sandbox working group, which is chaired by the director of the capital markets and collective investment schemes. So the sandbox working group, it oversees the sandbox participants throughout their life cycle. It provides the ongoing oversight of the design, implementation, and the operation of the sandbox, and it manages reports and escalates risks and issues if necessary to the next level of the governance structure, which is the sandbox steering committee. Okay, so the steering committee is chaired by Dr. Fani and our deputy CEO. The steering committee provides oversight of sandbox activities through review of the performance data of the applicant. The steering committee oversees risks and issues and escalates to the board as required. It monitors the development in other jurisdictions. It manages cooperation agreements with international regulators. It monitors sandbox activities to inform development of regulatory regime. And lastly, we have the board, which approves the sandbox vision and strategy. It receives periodic reporting on the sandbox for review. It delegates to board committees where required, and it receives details of any major breaches and risks via immediate escalation if necessary. Okay, so let's take a look at the duration of the sandbox regime. So it's a maximum of 24 months for an applicant, but there's obviously some flexibility depending on the circumstances involved. For the exit strategy, any eligible entity becomes a licensee to provide the eligible financial service under the relevant framework, or it will cease to be an eligible entity. On exemption conditions, the exemptions will not be available if the eligible entity has already been exempted for providing that type of financial service for the same kind of financial product. And it's important to note that the sandbox can only be provided for companies which will be testing their products for clients exclusively outside of Seychelles. There are obviously certain prerequisite conditions that must be met by the applicant if exemption ceases before the end of the testing period. Any non-compliance results in exemption being seized automatically, and FSA has the discretion to vary or withdraw these conditions or restrictions. Other conditions of which non-compliance does not lead to an automatic cessation. These will relate to notifications provided to wholesale clients before providing an exempt financial service, notification provided to retail clients before providing an exempt financial service, and certain procedures, memberships, and arrangements that must be in place. The approval period for these applications are within 14 days. Okay. So to conclude, I would like to say that our sandbox regulatory regime is 100% compliant with the needs of, with the requirements of international bodies, including FATF. And if you have any questions, we will be taking them right after this presentation, and Dr. Fani will be addressing those. Thank you.